As the digital trading bell echoes across retail brokerages and algorithmic screens flash live price action, Plug Power trades quietly in the low $2 range, anchoring a market capitalization near $2.94 billion. To the casual observer scrolling through financial social media or reading mainstream financial commentary, Plug Power is frequently dismissed as a speculative relic of the pandemic-era clean energy bubble, a high-beta vehicle characterized by endless cash burn, persistent dilution, and unfulfilled promises of a hydrogen-powered utopia. Yet beneath this superficial retail sentiment and the relentless short-term noise lies a profound structural reality and engineering bottleneck that standard financial media completely misses. The global energy transition is rapidly hitting a hard physical wall, electrical grid constraints and battery chemistry limitations. As hyperscale data centers, heavy industrial manufacturing fleets, and logistics megahubs demand continuous, uninterrupted gigawatt-scale power, traditional lithium-ion storage and overloaded transmission lines are buckling under the weight of thermodynamic and infrastructure limits. While retail traders chase fleeting momentum in overbought software stocks, institutional heavyweights or sophisticated market makers are utilizing these deep pullbacks to accumulate shares, systematically absorbing retail capitulation. Recent financial reports have shattered the bearish narrative of unchecked operational decay. The company's second-quarter earnings delivered a decisive turning point, posting revenues of $178.3 million, topping consensus estimates by over 5%, while slashing operating expenses by roughly 50% year-over-year. Most importantly, gross margins have pulled back from catastrophic negative territory to near break-even, validating management's aggressive restructuring under initiatives like Project Quantum Leap. Institutional desks are closely tracking the company's glide path toward positive EBITDAs by the fourth quarter of 2026, recognizing that when a high-beta enterprise structurally bends its cost curve while simultaneously raising full-year revenue growth guidance to 15 to 16%, the risk-to-reward profile undergoes a radical asymmetric shift. As the market digests these improving unit economics and non-dilutive liquidity initiatives, including asset monetization initiatives targeting data center collaborations, the weak hands are being systematically washed out, leaving an institutional shareholder base poised for explosive upside as execution meets expectation. Before we dive deeper into the operational engine driving this turnaround, let us pause. How are you currently playing the clean energy sector? Are you accumulating shares during these cyclical washouts, or are you waiting for definitive proof of sustained profitability before stepping in? Drop your thoughts in the comments below. To understand where Plug Power is heading, one must dismantle the outdated historical framing that views the company as a simple alternative fuel gadget maker or a vulnerable consumer cycle play. In reality, Plug Power operates a comprehensive vertically integrated hydrogen ecosystem spanning three core pillars: material handling, green hydrogen generation, and massive industrial electrolyzers. Historically, the company was pigeonholed as a niche provider of forklifts for Amazon and Walmart. While that material handling business remains a robust cash flow engine, boasting over 74,000 GenDrive fuel cell systems deployed across more than 280 sites and an upcoming multi-year refresh cycle involving over 20,000 from premier clients, it is merely the foundation of a much larger industrial behemoth. Today, Plug Power is a premier global infrastructure player. Its Gen Eco Electrolyzer division spans 5 continents, backed by an enviable global sales funnel exceeding $8 billion. These are not consumer toys, these are utility-scale, megawatt to gigawatt hydrogen production systems being integrated into massive green hydrogen projects globally, from Orica's Hunter Valley Hydrogen Hub in Australia to major European industrial deployments in Portugal and Spain. Furthermore, the company's proprietary hydrogen production network, with facilities operational in strategic geographic nodes across Georgia, Tennessee, and Louisiana, is rapidly scaling capacity, reducing dependence on volatile third-party chemical suppliers and dramatically optimizing fuel margins. The transition from a high-cost developmental enterprise to an optimized recurring revenue service and hardware provider is rewriting the company's financial DNA, shifting aftermarket service revenues up over 80% year-over-year as its sprawling global installed base matures. Looking toward the multi-year horizon, Plug Power's catalysts are deeply intertwined with the macro-structural demands of global decarbonization, energy security, and the insatiable power requirements of next-generation digital infrastructure. As mega-cap tech spenders and data center operators face unprecedented power supply bottlenecks, collaborative frameworks such as Plug's asset monetization initiatives with data center developers like Stream Data Centers are opening up massive new avenues for localized, clean baseload power generation. The technological gatekeeper positioning Plug holds in PEM electrolyzers and cryogenic storage cannot be easily replicated by software startups or traditional industrial incumbents globally. Naturally, risks remain, including geopolitical complexities surrounding clean energy subsidies, execution velocity on large-scale project final investment decisions, and the ongoing requirement to navigate capital expenditure cycles intelligently. However, management has demonstrated a relentless commitment to capital discipline, lowering cash burn rates significantly and securing non-dilutive liquidity to bridge the gap to profitability. When you cut through the emotional chatter of the daily ticker tape, the definitive takeaway is clear. Successful investing requires looking past short-term price noise and recognizing when a fundamental business model is undergoing a secular inflection. Plug Power is no longer just surviving the energy transition, it is engineering its backbone.